Thank you, Jaydeep, for the quick introduction. So a lot of people in India invest in mutual funds. Mutual funds in India is a $500 billion industry and growing at over 8%, 7 to 8% sort of CAGR every year in terms of AUM. So obviously we will cover mutual funds first, and like Jaydeep will walk us through the taxability for if you are invested in mutual funds as an NRI or OCI. Yes.
Yeah, so before we start taxation and FEMA, let's see how mutual funds are structured in India. So your mutual fund investments could either be an equity oriented mutual fund, which is the same as investment in a listed shares, or it could be a debt oriented mutual fund. Now, when I say debt oriented, it just means that it is not equity. Now, also the funds could be growth funds or they could be dividend funds. Now, growth funds give you return on your capital. Basically, you do not have a regular income, but the value grows. And dividend funds provide you regular income and have regular distributions as dividends. Now, income from sale of mutual funds are called capital gains. They could either be a short term or a long term, and your tax implication depend on whether it is short term or long term. Equity mutual funds are short term if you hold them for 12 months or less. For other funds, that is, they could be debt funds or they could be hybrid funds. However, the date of purchase is very important, especially this amendment was brought in by the recent Finance Act. So if you purchase your mutual funds before March 31st, 2023, then they would be considered short term if you hold them for up to 36 months. So up to 36 months, that is 3 years, your mutual funds are short term. But you must have purchased them before March 31st, 2023. Now, if you purchased in this financial year, that is after April 1st, 2023, they will always be short term. So there is no concept of long term for other mutual funds, that is non-equity mutual funds, if you purchase after April 1st, 2023. Let's talk about the tax rates. For non-residents, short-term capital gains from equity funds, it taxed at 15%. So that is a flat rate taxation, 15% on whatever gain you have. But from other funds, if it is a non-equity fund, the tax slab rate applies. So whatever your level of income determines how much tax you pay. Long-term capital gains from equity-oriented funds are taxed at 10%. But there is an exemption of 1 lakh rupees. And if the gains up to 31st January 2018, that is the notified date, till that date, there was no taxation on long-term equity-oriented funds or long-term shares. So gain up to that date is exempt. If there is a loss up to that date, that loss is also not allowed. Now, non-equity funds, that is debt funds or hybrid funds, are taxed at 10% without indexation if they are unlisted, or 20% with indexation. Now, this rates 10% with 10% without indexation and 20% with indexation are rates for all long-term capital gains, whether it would be from shares, mutual funds, real estates, anything. So these are standard rates. What indexation in India does, it allows you a benefit of cost inflation. So whatever cost inflation index is notified every year by the government, you get a benefit. So your basic income level is lower. Let's talk about dividends. All dividends from mutual funds are taxed at slab rate. So your taxable income determines what amount of tax you pay. These tax rates could be lowered by double taxation avoidance treaties with your residence country. So if you're a resident of USA, there could be a lower rate of tax. For non-residents, these transactions will also involve a tax deduction at source. So if you earned capital gains, it is more likely that you will have already paid the tax when you receive the funds in your bank account after sale. You may claim a refund if the taxes are over deducted, or you may be required to pay tax if you are into a higher slab and the tax deducted is a shortfall. Now let's go to the FEMA part. We are done with tax. So what is allowed and how it is allowed. So for NRIs and OCIs who are investing into India, like I said, there are two types of investments, repatriable and non-repatriable. Now, the choice of investment is with the investor. So as an investor, you can do a repat investment or you can do a non-repat investment. That is up to you. But how to do it is determined by the FEMA regulations. So repatriable investments can be done through inward remittance from your foreign bank account, or from your NRE account, or from your FCNRB account. Non-repat investments can be done through your NRO account as well. So in addition to these three forms under repat, you have an option to invest from your NRO account as well. Now, sale proceeds from repatriable investments could either be credited to NRE, FCNR, NRO, or it could be either remitted outside India to your foreign bank account. But in case of non-repat investments, they can only be credited to your NRO account. I think this is a basic idea of FEMA. Over to